Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines. Everyone, today we are diving deep into the world of satellite cell phones, a sector buzzing with activity and, let's face it, a fair share of hype. We've got a stack of sources to unpack this: Barron's, MarketWatch, and the Wall Street Journal.
What's intriguing is that we're witnessing a modern-day space race. But instead of moon landings, it's about beaming broadband from orbit. The question is, will this be a niche market for the wealthy? Or will satellite phones become as commonplace as our regular cell service?
Yeah, because who hasn't cursed those dead zones while hiking or traveling? But first, let's map out this new space race. Barron's gives a rundown of the major players, and it's a crowded field.
We're seeing a mix of established tech giants and ambitious startups. SpaceX is leading the charge with its Starlink network, and they've already launched thousands of small satellites. Then you have AST SpaceMobile, a company that Barron's really focuses on. They're taking a different route, using fewer but much larger satellites. They've secured partnerships with major carriers like Verizon and AT&T, aiming to integrate satellite connectivity directly into existing networks.
That's ambitious. AST SpaceMobile stock has been volatile, soaring after those partnerships but dipping recently, following a convertible note offering. Could you explain what that is for our listeners who might not be familiar?
Sure, a convertible note offering is a way for companies to raise capital. Essentially, they're issuing debt that can be converted into stock later on. While this can be a useful tool for growth, it can also dilute the value of existing shares, which might explain the recent dip in AST's stock price.
Makes sense. Now, back to the tech itself. Can they actually deliver 5G quality broadband from space? Barron's quotes Sarah Spangelo, a SpaceX engineer, who said cell phones are essentially underpowered, poorly located satellite antennas.
That's a critical point. Even with SpaceX's massive constellation, beaming high-speed internet to tiny, moving devices hundreds of miles away is a huge technical hurdle. AST SpaceMobile is facing similar challenges with its larger satellite approach. And then there's the cost factor. How much are people willing to pay for the service, especially considering many already have decent coverage in most areas?
Especially with competition heating up. Barron's highlights the price war that's already brewing. Apple is offering free emergency messaging via satellite through Globalstar.
And SpaceX is bundling Starlink service with T-Mobile's premium plans and offering options for Verizon and AT&T customers. These aggressive pricing strategies could make it difficult for AST SpaceMobile to charge a premium for its broadband service.
It'll be a fascinating battle to watch. But as MarketWatch reminds us, this isn't happening in a vacuum. They bring up the ever-present factor of inflation. And it's not a temporary blip on the radar. They delve into the 5-year break-even inflation rate, which essentially reflects what investors expect inflation to average over the next 5 years.
And this rate is currently hovering above the Fed's 2% target, suggesting that inflation might be stickier than many hoped. This has significant implications for the satellite phone market.
Absolutely. MarketWatch points out that sustained inflation could impact both consumer demand and the cost of building and launching these expensive satellites.
Exactly. Consumers facing tighter budgets might be less willing to pay for an additional service, especially if their existing cell service is adequate for their needs. And on the production side, rising costs for materials and labor could make it even more expensive for companies like AST SpaceMobile to get their satellites into orbit.
Let's shift gears to a market that seems to be thriving in this uncertain environment: gold. Barron's had a fascinating article about record high gold prices.
It's not just the traditional safe haven demander driving this surge. Barron's points to central banks diversifying their holdings away from the U.S. dollar. They specifically mention China, Turkey, Russia, and Poland as major buyers.
This trend of central banks diversifying their reserves could continue, adding further upward pressure on gold prices, and that leads us to a potential investment opportunity: gold mining stocks.
Barron's highlights that these stocks haven't kept pace with the surge in gold prices. This suggests there might be an opportunity for a catch-up trade, particularly if gold continues to climb or at least remains at these elevated levels. They specifically mention the VanEck Gold Miners ETF, GDX, as something investors might want to keep an eye on.
Now, to global news that might seem unrelated at first glance, Bloomberg had a couple of intriguing pieces. One was about France and India partnering on nuclear reactor development, and another was about sugar refiners in the Middle East cutting production due to weak margins. What's the connection here?
It's a reminder that even seemingly unrelated events can be interconnected in the global marketplace.
So, how do these stories connect?
Well, think of it this way. India's push for nuclear power is partly driven by their desire to reduce reliance on fossil fuels, influenced by global energy prices and climate goals. The sugar refiners, on the other hand, are struggling due to global supply and demand dynamics. potentially impacted by everything from weather patterns to trade agreements.
It highlights how events in one part of the world can have ripple effects across industries and geographies.
And these ripple effects can impact investors too, whether it's energy prices influencing alternative energy investments or global trade affecting commodity prices. Understanding these connections can give investors a broader perspective on the market.
Speaking of global connections, we can't ignore the issue of tariffs. Bloomberg had several articles highlighting concerns from Japan and the European Union about the potential for a trade war with the U.S.
These trade tensions could have direct consequences for the satellite phone industry.
How so?
Tariffs on imported materials and components could drive up the cost of manufacturing for these companies, potentially impacting their profitability and pricing strategies. And if those costs are passed on to consumers, it could further complicate the already competitive landscape we discussed earlier.
And as MarketWatch pointed out, tariff-related inflation could also make the Fed's job even harder, potentially delaying those interest rate cuts everyone's hoping for.
It's a complex situation. The Fed needs to balance the risks of inflation with the potential for an economic slowdown, and tariffs add another layer of complexity to their decision-making process.
While we're on the topic of uncertainty, let's talk about Tesla. Barron's covered the recent slump in their stock price. And it's not just about Elon Musk's bid for OpenAI, is it?
No, there are several factors at play here. Barron's points to the growing competition from companies like BYD, falling earnings estimates, and the overall volatility in the market as contributing factors.
And let's not forget Musk's other ventures and his, shall we say, colorful personality. All of this can create distractions and raise concerns about his focus on Tesla.
Right. Tesla is a company that often attracts attention, and that attention can sometimes overshadow the fundamentals. Investors need to separate the hype from the reality and consider both the opportunities and risks associated with this innovative but volatile company.
Speaking of innovative companies navigating a changing landscape, Bloomberg had a thought-provoking article about.
You know, we've covered a lot of ground already. Perhaps this would be a good time to take a break and give our listeners a chance to absorb all this before we move on to more fascinating insights.
Excellent point. We'll be back in a moment to continue our deep dive into the financial headlines.
All right, let's pick up where we left off. You were about to mention an article from Bloomberg that caught your eye.
Right. It's about Europe's efforts to revamp its financial markets. It seems they're trying to catch up with the U.S., particularly when it comes to tech innovation and attracting investment.
That's a significant challenge considering how rapidly technology is advancing. What are some of the key issues holding Europe back?
Well, Bloomberg highlights the fragmentation of European markets, different regulations and trading platforms across various countries create inefficiencies and make it harder for companies to raise capital and grow.
That fragmentation also impacts investors, limiting their options and potentially making it more expensive to invest in European businesses. So what solutions are being proposed?
Bloomberg outlines a few key initiatives. One is to create a more unified capital market across Europe, streamlining regulations and making it easier for companies to list on exchanges across borders.
A more integrated market could certainly attract more investment and level the playing field with the U.S.
There's also a push to promote innovation in key areas like fintech and green technology.
That's crucial for Europe to remain competitive in a global economy increasingly driven by these sectors.
And it's not just about government initiatives. Bloomberg notes a growing awareness among European businesses and investors that they need to adapt and embrace new technologies to succeed.
It sounds like a wake-up call for Europe to modernize its financial infrastructure and foster a more dynamic, innovative ecosystem.
But what does all this mean for investors? Should they be looking more closely at European markets now?
That's the million-dollar question. There's certain potential if these reforms are successfully implemented. A revitalized European economy could lead to increased growth and innovation, creating attractive investment opportunities.
Especially in those key sectors like fintech and green technology that they're focusing on.
Exactly. And remember, many European companies are global leaders in their respective industries. Their stocks could benefit significantly from a stronger, more integrated European economy.
So while there are challenges, there's also potential for those who do their due diligence and take a long-term perspective. Now shifting back to U.S. markets. MarketWatch had an interesting article about dividend investing. They suggest that focusing on dividend growth might be a better strategy than chasing high yields.
That's a classic debate in the investing world. High-yield stocks can be tempting, but as MarketWatch cautions, those high yields could be a warning sign.
You mean the stock price might have dropped for a reason, and the company might not be able to maintain those high payouts?
Precisely, MarketWatch argues that companies that consistently increase their dividends tend to be more financially sound and well-managed.
And those dividend increases can compound over time, leading to impressive long-term returns.
They gave a few examples highlighting Goldman Sachs' impressive dividend growth over the past 5 years. They also looked at some smaller companies with even higher dividend growth rates than their large-cap counterparts.
It's a reminder that investors should look beyond the flashy numbers and focus on the quality and sustainability of dividends. Sometimes those hidden gems with strong dividend growth potential can be found outside the usual suspects of the S&P 500.
Now let's turn our attention to the tech sector. MarketWatch also had an article about Supermicro, a company navigating a volatile market.
They recently lowered their revenue forecast for the current fiscal year, which spooked some investors.
But what's interesting is that they also projected significantly higher revenue for the following fiscal year than analysts had anticipated.
It sounds like they're betting big on the surging demand for AI infrastructure, particularly for NVIDIA products.
Their CEO Charles Liang expressed optimism, even suggesting that their $40 billion revenue target for fiscal 2026 might be conservative.
He's clearly confident in their ability to capitalize on the AI boom, but MarketWatch also mentioned some potential red flags.
Yes, they haven't yet filed their annual report for the last fiscal year, and they've received subpoenas from the Justice Department and the SEC related to allegations in a short seller report.
So while there's certainly potential, there's also some uncertainty and risk surrounding the company. Investors need to weigh both sides of the equation carefully.
Speaking of uncertainty and risk, let's discuss something that's been weighing heavily on market sentiment, the looming threat of a recession. Bloomberg had a rather sobering article about the UK economy.
What's the latest across the pond?
Economists are predicting that the UK's GDP shrank in the fourth quarter of last year, and there are concerns that this economic slowdown could persist.
That's worrisome, especially considering the global economic headwinds we've already discussed.
Bloomberg points out that the UK is facing a difficult situation. Their government borrowing costs are high, similar to those in the US, but their economic growth is much slower, more in line with the struggling Eurozone.
It's a tough balancing act for their government as they try to stabilize public finances while also stimulating economic growth.
And it's not just government policies at play, as businesses and consumers in the UK are feeling the pressure from rising costs and economic uncertainty.
Bloomberg mentions that the Bank of England has already cut interest rates 3 times since August, and they're forecasting slow growth for this year.
It underscores how interconnected the global economy is. What happens in one region can have ripple effects elsewhere.
And it highlights the importance of diversification for investors. Spreading your investments across different asset classes and geographies can help mitigate risks in uncertain times.
Now, earlier we touched on the housing market, and the Wall Street Journal had an intriguing article about Zillow.
We've covered a lot of ground in this segment already. Maybe this would be a good place to pause and give our listeners a moment to digest all this information before we delve into the housing market and other news.
That sounds like a good plan. We'll be back shortly to wrap up our deep dive into the financial headlines.
Welcome back, everyone. Before the break, we were about to discuss the Wall Street Journal's take on Zillow and its strategies for navigating the current housing market.
Yes, it's interesting because Zillow is projecting revenue growth, even though there are considerable headwinds in real estate right now.
It seems counterintuitive, right? The Journal acknowledges challenges like those high mortgage rates we discussed and the uncertainty around President Trump's policies on tariffs and immigration. No one's quite sure how those will ultimately impact the housing market.
So how is Zillow planning to achieve revenue growth in such a volatile environment?
Well, Zillow CEO Jeremy Waxman seems to believe the limited housing supply is a more significant issue than fluctuating interest rates. They're advocating for measures to streamline building processes and increase housing availability.
That's a long-term approach, focusing on expanding the market itself rather than just competing for a piece of a shrinking pie. It's interesting that they're taking this stance.
And they're putting their money where their mouth is. The Journal mentions Zillow just became the exclusive provider of multifamily rental listings on Redfin, opening up a master new market for them.
That's a savvy move. Recognizing that buying is slowing down, they're tapping into the rental market where demand remains strong. It speaks to their adaptability in a shifting landscape.
Adaptability seems to be a recurring theme in today's deep dive, whether it's satellite phones, gold European markets, or housing. A keen understanding of the bigger picture and the ability to adapt are crucial for investors right now.
I couldn't agree more. It's not about chasing quick profits or the latest fads. It's about informed decision-making, recognizing both the risks and the opportunities in a constantly evolving global market.
Well said. We've reached the end of our deep dive for today, having explored a wide range of topics from the potential of satellite technology to the enduring allure of gold, the challenges facing Europe's financial markets, and the unpredictable nature of the housing market.
We hope you've enjoyed this exploration of financial news and gained valuable insights. Remember, knowledge is power. The more you understand the forces shaping the global economy, the better prepared you'll be to make wise investment decisions.
Exactly. Keep asking questions, stay curious, and we'll see you all tomorrow morning with new headlines from major financial magazines. Until then, Happy investing.